Well, welcome to MasterMIND. Somehow, magically, it seems like we've got the wrong intro, but that's okay. I'm your host today, Joel Thomas. With me is Jake Ostrovskis from Wintermute. And Jake's going to be walking us through their Bitcoin mining hedging playbook for miners. You're going to learn about how Bitcoin miners can protect their operational revenue from market price volatility. Now, Jake has a absolutely fantastic presentation lined up for us today. I'm super excited to learn from you, Jake. So welcome to MasterMIND. How are you today?
Yeah, thanks for having me. And yeah, thanks. Really good to be here and look forward to sort of running through this. And thanks for the invite, I guess, from across the pond. So yeah, I appreciate being asked to come on.
It's our pleasure. So let's kick this up here so they can see your awesome presentation. And I'll let you take it away. And yeah, I think just to kind of start this off and warm this up a little bit, I think one of the major challenges for Bitcoin miners is cash flow, right? Because what happens is, as we're all painfully aware right now, sometimes the price of Bitcoin, when we think is going to go up, goes down and stays down for a while. And as a miner, you have a cost production floor, and that can put a lot of strain. And if you're not properly hedged, that increases your risk profile.
Yeah, no, exactly. And I think a lot of the initial interaction definitely we've had has been around those two problems, really. Like, how do you first of all maximize yield on otherwise dormant treasury holdings, and also how do you hedge against fluctuations, which is within, I guess, as we've seen and consistently reminded, that it's a very, very volatile underlying asset at the end of the day, which on the upside it's great, but obviously on the downside there's a trade-off there. So yeah, hopefully we can sort of glean something from this hour or so that we have.
All right. So I'll let you dive into your presentation and tell us about Wintermute. What do you guys do? Who are you?
Yeah, awesome. So, I mean, just to contextualize and sort of frame the whole discussion. So for those who are not aware of who Wintermute are, where we sit within the market. So we are, by and large, one of the largest market makers in the space. We are providing liquidity on a wide array of asset classes. We started in 2017 primarily as a algorithmic high-frequency trading firm, which specialized in centralized exchange trading. That was across all the C5 venues. Then we plugged on D5 venues, spot, perps, options, as we'll get into, and then other derivatives. I lead the over-the-counter desk here at Wintermute, and what that means is that we do bilateral trades with a variety of different counterparties, whether that is a high net worth individual, whether it is an institution, an asset manager, and by and large, one of the largest parts of our business has naturally been digital asset treasuries and miners.
So one question I have on that is, so how does over-the-counter trading work versus going on an exchange? So for example, if I'm a miner and I send my, to my Coinbase wallet, then I want to offload my coins, how is that different than using an OTC desk?
Good question. So when you trade on an exchange, as you said, the flow of funds is you send your capital to an exchange, you sell it, and then you remove it off the exchange. People will try and onboard with an over-the-counter trading desk because of a variety of reasons. I mean, by and large, when you trade with us, you're basically trading with us on a bilateral basis. So if you come into me, you send in some Bitcoin that you're wanting to sell, I personally will give you a price. When we agree that block trade price, that is the price we executed at, and then we run through the settlement legs. The benefit of doing an over-the-counter trade rather than an on-exchange trade is a few different reasons. First of all, we often extend credit lines, which means that you don't have to pre-fund transactions in a lot of cases. The natural benefit of that to a miner or someone trying to offload large blocks is that the trade is very discreet. So it's almost like we do the trade and then we will then hedge it out ourselves in the market, and therefore there will be little market impact on your side. We'd also anticipate the price to be much sharper than if you went and did the trade yourself on an exchange. So I guess, again, good example, we're live as a trading firm across about 35, 40 different centralized and decentralized exchanges. That means that when you can just plug into your Coinbase account, press sell, and there's a little bit of liquidity on the bid where you can sell into. If you sell it to someone like Wintermute, we are able to lean on liquidity in all the exchanges, which means that the price is significantly sharper, which naturally, if it wasn't sharper, we wouldn't win any business. And then you obviously have these additional benefits like credit, allowing discretion around the trades, minimal market impact. And by and large, another area where we're getting more and more involved in the trading as a bilateral counterparty is more on the market color side. So actually it's like, okay, if you come to us with a big block to trade and you try and do it on a Saturday afternoon, we might say this is the price now for you, but if you wait until Monday morning or Monday morning US, then the liquidity is going to be better in the market. So it's a more white glove human element than if you just go and click trade out on a exchange, which naturally is more institutional kind of flow that I guess benefits from that structure.
Okay, that makes sense. So one question I have that's kind of a derivative of that is sometimes on X, and again, I don't do what you do every day, so I don't have the knowledge of, and maybe I think a lot of people watching may not have some of the knowledge of some of the technical stuff we're about to talk to, but I see people talking about like large institutions, large miners, et cetera, trading on OTC desks and it not impacting the price. How long does it take for somebody like, say, Michael Saylor buying a massive quantity of Bitcoin to reflect in the price versus if they were to do it on the exchange?
So most of the large blocks that you see reported, especially in the media, because obviously there's a big headline number behind the size of the trade, media pick it up, and that's, I guess, what ends up on crypto Twitter, on Bloomberg, on Reuters. Most of those are executed by something called a TWAP, which is a time-weighted average price. So that instead of a spot transaction where we would just agree a set price, which will be, if you're selling, I will give you a price that's slightly below the mid price. And that will be the trade done. That's called a risk transaction, a risk transfer trade. In the case of a TWAP for very large trades or people who aren't really time sensitive, i.e. they just say, okay, I've got a week to buy or sell this amount of Bitcoin, they will split that order up on a linear basis and they will lean on algorithms that are run by a trading desk. So we run a variety of different algos which execute into the market. They do so very, very slowly over a preset period of time. And the idea there is that it spreads a large order out and therefore really minimizes market impact. So there's sort of a couple of different ways on the spot side that you can play around with execution to ultimately achieve exactly what you're trying to do there.
Fascinating. Thank you for clarifying. I've always wondered that. And like I said, if you go on X, you definitely see a lot of, I think, confusion about how that process works and how price gets affected. So that's very interesting.
Yeah, exactly. So yeah, I mean, that's ultimately the backbone of the over-the-counter desk. So we're facilitating trades on a spot, forward options basis alongside various different algorithms that we're able to utilize. To give you an idea of, the scale of operation, we trade this is probably on the low side, we probably trade more like 450 tokens. On an average day, we'll trade about $5 billion of notional value, and that is across a variety of different business lines, but all as with Wintermute as a counterparty. So hopefully that sort of frames where I'm coming from this from. So yeah, as you mentioned, I think you gave a good overview of sort of things we were going to touch on today. Ultimately, the core problem, where we start, and then different kind of hedging instruments that really we see people utilizing more and more. When I say people, I mean treasuries, whether that historically has just been Bitcoin treasuries, but now we're seeing a wider range of different assets coming online from plenty of different corporate entities last year, for example, raising a ton of money to put different assets, whether that's Ripple, Solana, Ethereum, and I guess the rest of the tails that ended up getting onboarded through the end of that cycle, which now everyone sort of faces that core problem, which is especially more prevalent for miners, which is, I guess, like the costs are fixed, but the revenue isn't, especially if the revenue is very, very, very related to Bitcoin price. Taking out, obviously, those with other contracted revenue from conducting or undergoing AI, HPC pivots. If we boil it down to like the core problem is that in a bull market, the profit is expanding exponentially and your costs are fixed, which in reverse, it's almost as reflexive on the way down. So whenever we are first approached by a pure mining company, the question is always, okay, what are you trying to achieve? Are you looking to be a beta to the market and actually you don't mind the volatility in your balance sheet, which actually that is also a very, very valid approach. And for those counterparties that come and say that, the solution is very, very different. But if someone comes to us and says, okay, actually, we do want the upside, but at the same time, we've been through a couple of cycles now, we've seen the pain, because they're painful periods for everyone involved in the industry. And that pain point tends to be where we get involved in order to try and almost mitigate and soften. So there's a few different...
Do you want to... Sorry to cut you off. Do you want to maybe talk about, I see that equation there as something that I think is important to mention, where you've got, the total Bitcoin mine times the Bitcoin price divided by the operating expenses in USD plus the CapEx in USD equals a profit margin. And, when the Bitcoin drops 40%, your costs stay the same. And obviously that's not something, depending on the scale that you're operating at and, the amount of the investment structure behind your business, which again is going to change for every mining operation, because you have some people who are self-funded, some people that are funded by, say, large big money groups of people, etc. There's a lot of different situations out there. So what you guys do is you help people hedge and convert that Bitcoin price uncertainty into actual cost certainty.
Yes, exactly. And that can be led by a variety of different factors. Some people have, as you mentioned, there's a wide variety of mining companies we work for. On one side, they have people, they even have that they'll be having to meet very, very large payroll obligations, for example. So that is something that takes precedent in terms of how do we make sure every single month we have this much. And a lot of them don't, or historically haven't wanted to sell the Bitcoins. Then it becomes, okay, how can we do this without, and just making sure that we can meet obligations. Right the way down to, I guess, financing different kind of CapEx expenditure, or even paying out debt. Like when people have taken on debt in order to acquire Bitcoin, especially, then it becomes, okay, how do we make sure that actually that embedded leverage is not going to be devastating if the market does turn. And that's sort of where we've seen the demand from the market come. But yeah, you're right. It all comes down to this equation where you have a set amount of costs, which naturally they're much stickier than the Bitcoin price. So when Bitcoin dumps and the profit margins compress, that is naturally what we're trying to solve for. Yeah.
Fantastic. Okay, so what are those, what are those next steps then? The main tools that people are using here to protect their mining treasury?
Yeah, so I mean, we've sort of gone through, you could almost call this the evolution of tools that have been demanded by bilateral OTC desks and the mining client base. When we first came online and when the section really started to seek solutions for this kind of revenue hedging, the first tool that people would lean on is something called a forward. Now, forwards are very, very, very well utilized in traditional finance. The market there really grew, especially around sort of foreign exchange hedging. So what was picked up from there is that, okay, like in a very basic level, a forward is, we will give you a price today for delivery in the future. So say, for example, Bitcoin, when it was trading 120,000 back in last year, and someone then said, okay, I'd like to actually lock in this price, but we're not going to have X amount of Bitcoin until 1 year's time. We could offer a forward price around that point in time, which may be some form of, well, it would be some form of discount to 120,000, but we would give you the price there and then. And what that does is it gives you clarity on the next 12 months where you can sell that Bitcoin at. So it might be that, okay, the forward that was locked in October last year was 110,000. For the sake of argument, it would likely be much higher than that, just to keep numbers rounded. No matter what happens to Bitcoin price now, even if we went down to theoretically zero, we would still be paying you for your Bitcoin that you forward sold at that higher level. So that was the initial product that was used by the mining space in order to lock in future obligations. The benefit of that is you can be very, very specific in terms of cash flow. You can match certain balloon debt payments, and it was very, very simple. There'd be nothing needed to pay up front. The downside of those products for a miner as a counterparty is they require some form of margin. By that, I mean, okay, if you do the trade for 100 Bitcoin, there would be maybe a 10 or 20 Bitcoin initial margin requirement. If that Bitcoin kept rallying and the miner was short the forward, i.e. willing to sell the Bitcoin at a fixed price, and the market kept rallying, there would be subsequent margin calls, which people have very different views of that. Ultimately, there is some potential, especially in an asset which we've seen appreciate a significant amount, that actually people are then capping any upside price exposure, which by and large, while they do have some benefit in a portfolio of risk management strategies, they were basically overwritten from the viewpoint of, okay, we would like to retain upside. We don't want to have to completely place initial margin, and we don't want the risk. We have to continue to do so. So then we saw what you call put options that came to market, and basically what that is, we would sell you an option to sell Bitcoin at a price under the current market. In order for that contract to be paid initially, you would pay something called a premium. The premium is one small upfront payment, which gives you the right but not the obligation to sell that Bitcoin. So in that same example, if Bitcoin was trading at 120,000, you bought 110,000 put option. If the market then crashes to where we are today, you would still be able to sell the Bitcoin at 110,000. And all you have up front is almost like a balloon payment. We call it a premium payment, which is very, very akin to an insurance premium that you might pay to insure anything, a factory or a natural disaster. And that was how it was always framed. With put options, you have the benefit of not having to collateralize. So there's no moving collateral requirement if the market continues to rally. The downside is you pay a premium up front. And if you're doing that every month, for example, for years, that is obviously then something that needs to be thought about when you are putting cash flow together, but ultimately you retain all the upside. So if the market got to 120, you bought $110,000 put option, but the market rallied to 200,000, you actually don't have any obligation to sell the Bitcoin at the put strike price in 110. You would still be able to go to market and sell it. So that was the trade-off there. The natural pushback of put options is that, okay, they're great for all these reasons that I've just mentioned, but you have the premium that you have to pay up front. And therefore we saw something which was really interesting called a zero cost collar. And what that is you, instead of just buying a put option where a premium is due to us, for example, as an over-the-counter desk, you would do two things. You would sell a call option, which is above the current price. And instead of using that premium and just retaining the premium on your balance sheet, you would use that premium to buy a put. Now, what I mean around that is, on the flip side of, we just spoke about buying put options. If you were to sell a put option, or in this case, a call option, rather than you paying Wintermute a premium, that flips on its head, and we would pay you a premium as a miner for putting that trade on. And what that allows you to do is, if you, again, going back to the similar example, if Bitcoin is 120,000 and you sell 140,000 call option, we would pay you a premium. What that means on your side is, if the Bitcoin did rally over 140,000, you would then have the obligation to deliver the Bitcoin. So ultimately what's happened there is you have sold Bitcoin at 140,000 if the market continues to rally. On the flip side, if the market stays where it is or goes down or really does nothing in the time that we put the trade on to expiry, you will retain that premium. So that is just a simple call overwriting program, what we call it. So it's just selling covered calls. The difference with a collar is then the premium that you would have initially retained is then used to finance a put, which gives you all the downside protection from that put strike. But ultimately, you're paying a lot of the time nothing, i.e. zero cost collar, because the premium that you've paid for the put option is offset by that you've received from the call option. And ultimately, that gives you a position. So if Bitcoin is 120,000 and you sell the 140,000 call and you use that to finance a $100,000 put, what you've then got is if price rallies, you're selling your Bitcoin at 140,000, so a better price than spot is currently. Alternatively, if Bitcoin drops, then you're also protected underneath that lower strike of the put. So that really has been a popular product because you're doing two things. You're selling higher than the market if it rallies, but you're also retaining downside.
Good way to think about this, I think it would be an insurance analogy. It's like taking out an insurance policy on the price of Bitcoin. And I think, I don't know if you ever have done anything in the insurance market or not, but remember at one point I sat down with a financial advisor many years ago and I bought what's called a LIRP, or a life insurance retirement program. And these policies, they have capped upside, but they also have total downside protection, which is nice because when you see the math of losing, for a classic example would be like if the price of something goes from 100 and goes down to 70, it loses 30%. What percentage you need to get back? And most people would say 30, but I think it's 43 if my math is not mistaken. So the point is losing money costs you more than you think. In terms of percentage. So that was a big thing that they were talking about, was the way that these insurance companies hedge risk is they buy options like you're talking about so you have capped upside, but you also have capped downside. And that keeps your returns within a certain window when you're in a volatile market. So that to me, I think is probably a good analogy, I think, for what you're explaining. What do you think?
Yeah, no, I think that's exactly right. And ultimately options are, by and large, they are an insurance product. The first option contracts, really, when they were first created and rolled out, were basically insuring ships to when they were crossing the channel, or they were going and doing big expeditions from like London to the US, and people would buy an option on the ship or buy a put option on the ship. And that is basically how they grew. So by and large, that's a really good framing to think of them as insurance products. But there's a huge amount of different things that people can do. And there's definitely no right or wrong way. Like we see, I think our active book of mining and asset clients is in sort of the 30-40 range at the moment. Some naturally are way more active than others, but there's not a single one size fits all solution, which I guess is the beauty and why things keep very, very interesting. And also, it's never the case of, okay, you have to, or the right way is to just pick and choose one of these products. What often happens is that there's a sort of bespoke kind of strategy based on, again, like cash flow, yield generation, risk profile, even like upcoming view on the market. Like if someone thinks the market is likely to trade soft, like maybe they then are a bit more aggressive on the hedging side, or whether they think their market is going to go up, they'll maybe lean off a collar structure, for example, and they'll just be more inclined to sell in the spot market, or they'll do a mixture on their balance sheet. So maybe it will be, okay, 20% of their revenue or their balance sheet would be collared, and therefore at least you have some protection. Then 80% might be just left to run freely because they're willing and they're able to, I guess, have visibility on that 20% for the next year that allows them to do that. So there's definitely no one size fits all, and it all basically corporate strategy, management, all of these things come into the decision. But yeah, that's sort of the main toolkit that we lean on in a basic form. There are other products that we do use, which are more on the structured product side, but many of those fit more into what we would call the yield generation scope rather than hedging, which is a sort of different question altogether, but again is used in the context of sort of treasury management, which we would call it.
Very interesting.
But yeah, I guess we've sort of just gone through there with a hopefully a bit of a worked example there. Just flipping through again. So buying new put, you're buying the premium up front. Bitcoin falls below the strike. The miner would then be able to sell the strike. However, any option is an option, not an obligation. So if the price continues to rise, you still get the full benefit. Selling a covered call that we touched on there is people receive the premium, which when that's used on its own, that is a yield generation product, i.e. when you sell the call, you retain the premium. And then the zero cost collar is when you roll that premium into a put. So actually the net balance sheet impact up front is zero, but you get the protection and you can also sell almost like a limit order on the upside. So that tends to be how those products sort of take focus.
Do we want to run them through that example real quick?
Yeah, exactly. So this was current Bitcoin price. Obviously, we can pretend we're back up at 90 for the sake of argument. But yeah, if there was a monthly obligation, known obligation of $400,000, and you were to buy this $70,000 put, you're buying the $75,000 put, but you're selling a $110,000 call. So if price is 90, there's two outcomes that can happen here. Well, three really. Price stays in the middle of that range. In that case, if the zero cost collar is structured correctly, then the net impact is zero because you've not lost out on the price impact. The put offsets the call offsets the put, and then the net impact is zero. If the price rises to and through 110,000, you would sell, in this case, 10 Bitcoin at 110,000. And if it falls below 75,000, you would then be able to sell 10 Bitcoin there, despite the fact, even if it dropped to, again, theoretically zero, you'd still be able to sell the Bitcoin at 75,000. So what that does is it gives you a revenue floor, i.e., okay, the worst here, we have 75,000 a month on this kind of structure, which we can cover. And your upside cap, if this is the whole balance sheet, would be, okay, you're going to be selling 10 Bitcoin at 110,000 if the market rallies, and therefore it would cap the upside. But again, that's only if your full balance sheet is in there. How other people tend to do this is they will sell calls. If someone needs to sell X amount of Bitcoin to fund expenses, that is normally the amount that they will be willing to sell a covered call on. So yeah, hopefully that makes it a little bit clearer. But yeah, ultimately the hedge outcome there is uncertainty, and the volatility of the balance sheet slows down significantly.
I can see how this would definitely be a very, very powerful thing if you're sitting there in a finance budgeting meeting and trying to figure out how to, lower your risk and make sure that, these wild market swings that we sometimes experience. I mean, for example, what was it? A few months ago, we had that day where Bitcoin just plummeted out of nowhere, and nobody expected that to happen. So this is where a strategy like this, I think, can really help save you in a situation.
Exactly. Yeah. And really what we've seen throughout the cycles, I mean, the first cycle when options just came online, they were used solely as speculative assets. People just wanted to speculate on the market, and that's natural. Like, it was a new nascent market. There was no real way to price Bitcoin, which I guess there still really isn't, but there was much less certainty on, okay, where is a fairer long-term sort of average price here? So people just wanted to speculate on the upside by buying call options. Now, as the market has become more institutionalized, all of these products, which are very, very, very well used by corporate treasuries in traditional markets, have now come over. And in traditional markets, the underlying tends to be foreign currency. And then obviously in the mining space and digital assets, the underlyings tend to be a little bit more volatile. So yeah, they're definitely becoming more and more used, and hopefully this example was fairly useful to, I guess, just show you exactly like a work through. But yeah, hopefully sort of you've got a good overview at the moment of how we tend to engage with miners. There's a few different ways, and as I mentioned, that there is never one size fits all. That I think falls under This tends to be a rough guide of how we get involved. So first of all, there's an initial call really to understand, can we help you? And by and large, the answer is yes. There's occasions when the answer is no. If the answer is no, it doesn't make sense to engage for both parties, and we'll be very open and honest about that. The reasons why there might not be is that there is, I guess, no request or willingness to want to sell any balance sheet assets or hedge. That some entities are just looking for pure upside. And again, that is a valid strategy, but it's not one that we can then come in and really assist with. So what we would normally do is we'd sit down on a first call and we'd try and understand, like, yeah, hash rates, OPEX structure, what the current inventory looks like, what the debts are, what the obligations, what kind of strategy the board and the CEO, the leadership level really want to pursue. And after that, we will then map out US obligations, Bitcoin production, try and identify potential pain points before they occur. And then we can just suggest a few different structures with different trade-offs as we've just been through. So there's never one size fits all. It's likely going to look like, okay, if you're wanting to sell this amount of Bitcoin every month, maybe we look to sell covered calls, which means that you're getting the premium if you don't sell, or if it goes through, then you're selling at a higher price. Some of the treasury, again, we go back to, okay, we're going to collar some of this. So there's some visibility on upcoming costs. Sometimes there is a individual contract somewhere in the business, which there's a cost structure that's tied to XYZ amount over a smaller period of time, where actually a forward contract is more relevant. But all of those will come together into a form of this is what we can do. But the beauty of it is that it can all happen under one roof. How that is structured on the back end is that we would onboard a counterparty as a corporate entity, and we operate on what you call an ISDA CSA setup. Now, this will be for anyone familiar with any sort of financial markets in the traditional world. It's basically a cookie cutter approach. We are a traditional trading firm desk ultimately, but the only difference is we trade digital asset underlying. So we're operating with these ISDA and CSA frameworks, which likely need a bit of legal negotiation, and then executed. These things can take as little as a day. They can take as long as 3 years. So sometimes, and all things in between. So it just comes down to the counterparties, how we're wanting to act with them, how they're wanting to use us to transact, what the sort of margin requirements might be. And after that, then it's ready for live execution. I think like ultimately what we tend to see is that during good times, people tend to sit back and obviously enjoy them, which is, I guess, the best thing anyone can do in terms of sort of riding it out. The problem with that is that then when things do start to turn, when these kind of products are needed the most, they're not in place already. And that's when we see people scrambling to onboard and put through complex legal negotiations. In some instances, the majority are fairly simple, but whenever you're talking about legal agreements, there's obviously some lead time, as there should be. So yeah, that tends to be sort of the workflow there, but it all comes down to trying to understand the business at a core fundamental level before trying to structure something that fits.
On average, how long would it take somebody coming in the door to get set up?
On average, I'd say probably 2 or 3 weeks. We always I prefer to sort of under promise, over deliver there. But yeah, 2 to 3 weeks seems to be the average, but it also comes down to how motivated the onboarding counterparty is. We turn things around on our side. Any holdups are usually from experience because the market is good and there's no immediate need. When, like in the last 3 or 4 months, we've seen people really pushing onboarding to the point where, okay, maybe we do a 3 or 4 day onboarding, which is just back and forth with documents, but it's a standard corporate due diligence process, which people would have done for any sort of account opening before, whether that's like a bank or a payment provider, or even just sort of standard due diligence questions. So yeah, hopefully it's never too intrusive, but we always say leave enough time, don't wait until it's too late, basically.
Very good to know. All right.
So yeah, I guess like going through a few of the actual questions that we will go through in that initial, I guess, analysis. The first of all is obviously what's your all-in cost? I mean, this is going to obviously dictate a lot of things. It gives you a lot of idea about, okay, that is really the floor. Under that, it's naturally going to become painful. Over that, it's, I guess you could call it profit, just on a gross basis. But that is sort of what we try and understand on the first time. And then it comes down to, okay, how much of the production, therefore, should you hedge? We see a wide range at the moment, and also this changes a huge amount based on the market. Again, like in this time last year, we saw these hedge ratios right at the lower end, which were sometimes none. A lot of them were in like the 30 to 40% range. Now we're seeing this right at the other side where the actual production is being hedged. In some cases, 100%. I'd say the median at the moment is closer to 70. And that's obviously been in line with a lot of these, I guess, big scary headlines and people looking to trade out or reduce balance sheet exposure, especially on the public company side with pressure from shareholders. But we see this basically oscillate based on where the market is. How we normally suggest going about this, rather than taking a reactive and a lot of the time quite emotional response to how the market is doing at the time, is we would suggest mapping out US obligations and then looking at Bitcoin revenue by month. They will be subject to various assumptions that, okay, if Bitcoin is where it is today, that's one. Okay, what happens if the market goes up 10%? Where are you at that point? What if it goes up 20 or 30 or 40% in that period? And we do the same on the bottom side. So then ultimately you end up with almost a matrix of obligations versus potential incoming revenue. And that gives us a lot of information just by itself to be able to then look at how and when these payments are required, what the likely, looking at a big range of outcomes and assumptions, what that might look like. And then it allows us to like match hedges to any sort of CapEx cycle or working costs or payroll or anything that might be. So that's the sort of, hopefully an overview more specifically of how we would look to sit down with management teams. There's obviously a few more levels underneath that, but by and large, if there was 3 questions to ask and I had a gun to my head, that's probably where I'd begin. Yeah, I guess that sort of goes through a number of different, this would be, okay, in a normal market, how does the hedging sizing really get dominated by different, I don't know, drivers and entity structures. So when we see like the big public miners, they're obviously tend to be a bit more highly leveraged. There's obviously a lot more shareholder pressure. They're therefore having to hedge by and large in a normal market a little bit more than someone who has a lot more, I guess, freedom, and maybe they're a solo miner with lots of freedom, and actually they can make their own decisions. So that's really where we see like collars and forwards being used. Forwards are often used by the big public companies, naturally, because they tend to have a lot more cash on the balance sheet, and therefore they are willing to have a huge amount of certainty over what's coming in, but at the same time, they have enough cash to pay any margin calls. They also, we see them tend to hedge out a little bit further in time. So whilst the smaller early stage ramp up ones might look at, well, I guess the self-funded ones definitely will look at the sort of the 1 to 2 month windows. We see big public miners and people who are scaling up looking a bit longer tenors. Usually on the public side, they tend to be more in terms of 5 or 6 months. On the early stage ramp up, they may be looking at 3-4 months. That tends to be where it is. And then as you see here, everything in between. But by and large, one of the most popular and current products, if you strip all of this back, is almost every single different entity is using outright puts. Some of them will pair that with the call, as we mentioned, to overwrite in a collar format. Some will just buy close to the money puts, and some will buy quite far out the money puts as insurance. The distance from being at the money to out the money, the difference there is just the price of the premium that you'd pay. So again, I guess an example there is if a Bitcoin's trading 100,000 and you buy a $10,000 put, it's going to be way cheaper than if you buy a $90,000 put, which can be quite expensive. So that's also a bit of a trade-off. And really, we see several different kind of entity structures that then have different debt loads, different requirements, all lean on different kind of products.
Is there any other reasons that the tenor would, contract or expand depending on the type of miner profile?
Maybe not on the miner profile. We do see the tenors move around based on the underlying market. What I mean by that is, so when you are buying an insurance product, to use that analogy again, because I think it's a really good and relatable one. So if you think about buying a insurance product for 1 month versus an insurance product for 6 months, the probability of that paying out in a pure insurance form over 6 months versus 1 month is much larger. And therefore you expect a premium for that coverage to be larger as well. So that is another thing that we see people changing tenor around. And by that, I mean, okay, when the market at the moment is or has been in sort of this fear factor where people are paying a lot more for the insurance, i.e. the puts are literally naturally more expensive. Therefore, maybe people go from this 6-month window, if you're a public listed company, to actually just hedging for 2 months because the premium is more expensive on a relative basis. Whereas obviously on the flip side of that, in a really strong bull market, when no one really wants to insure downside, then people will be hedging for longer because the premiums are a little bit softer. I mean, it's akin to insurance in, let's say, after a natural disaster, if someone wants to insure their homes right after a flood, or insuring a building as the fire is already burning kind of thing. If you're trying to do the latter, it's going to be more expensive. And that's when we see people playing with the tenor as well.
Yeah, I think of like 1 year versus 10-year term life insurance, right? The cost is variable depending on the term.
Yeah.
Also, the risk is variable in other factors. Okay, that makes sense. Thank you.
Yeah, no worries. So yeah, I mean, this is, I just thought there's a few obviously war stories that, or common pitfalls that we see happening. And this is from, these are, I guess, things that we see and have seen time and time again, especially as the industry has come out of its infancy into this sort of mature thing that we see today. Going back and trying to link them back to the products, as we mentioned. So if you were, for example, like hedging using forwards in a bull run, if, for example, your miner sold forwards and Bitcoin was at $40,000, Bitcoin then continues to rally to 100,000. That therefore is a unrealized loss technically, because you've sold at 40 and actually it's gone up to 100, but you have you need to be delivering that at 40. So you have a $60,000 unrealized loss there. That's when we've seen obviously boards get quite, I guess, that's when things would obviously need to be changed if someone had made the decision to hedge the whole balance sheet into a bull run. Obviously the bull run element here is retrospective. You can't know that at the time, but then that comes down to how do you manage that without putting the whole balance sheet at risk if there is this huge move. So there's a big opportunity cost basically, which can ultimately lead to equity destruction if not done properly. That also is similar to using exchange futures. So the alternative often that we hear, especially at the early stage or like scale up mining firms, is that, okay, if I have an obligation, it's only a month out, why can't I go and sell perpetual futures on Binance or on an exchange? So, I mean, that's also a valid point. Where we see that going wrong is very, very similar to over hedging in a bull run. Obviously, if Bitcoin rallies and you're left having to face a big margin call, we've had some fairly, I guess, leaning more into the war stories area, we've had people with open positions on exchange, their collaterals held in a multi-sig, and actually what's happened is Bitcoin's rallied, they've been hedged short, they've failed to meet a margin call because the third signer was sleeping or has been on a flight. And that's a genuine, I've seen that happen before. And the result of that is the shorts, the hedge that they had on an exchange gets liquidated, and then they're left with just an open position and their collateral's all gone. So yeah, that's a sort of other option that we've seen happen. Hedging at the worst time, we briefly touched on it. You're hedging when your house is on fire, and it goes back to having things in place before it's really needed. Back to the start of February this year, and I'm sure people saw the headlines about options premiums had hit one of the highest levels all cycle because everyone was paying up for puts because there was a lot of fear in the air. And that was driven by market-wide liquidations. We saw people paying up for puts, arguably a little bit too late, because at that point, the amount that you're paying for the option is by and large going to overwrite anything that the benefit would have given you. So it's all about having things in place beforehand, which again, going back to that sort of cycle, is if you don't have the documents in and you're trying to push things through last minute, that's when things become problematic. So yeah, your sort of 2 to 4 weeks minimum is precedent again. And back to more specifics, we also have seen in the past, and when we've come in to look at structures that might be in place, I think there's a common pitfall where people will look a little bit too systematically at hedging. And by that, I mean they will look at the market in general, and rather than looking at incoming obligations, and there'll be a big mismatch, which might look like, okay, a CFO thinks that they've hedged or the job is done because there's been a hedging on a monthly basis, but actually the obligation, the balloon payment, is due in 6 or 7 weeks, and there's now a mismatch between your liabilities, your balance sheet, and that can obviously, most of the time, that's going to be okay, but the longer you stretch that planning period out, the more you can match things up, the more you could sleep at night, and the more sort of headspace come in. And then, yeah, right back down to like the cost basis problem. So yeah, ultimately it's just understanding everything that is going on in the business, sharing the information freely, and then working together to sort of try and make it one cohesive strategy, rather than basically doing what we think should be done without opening the lid and getting under the hood a little bit.
You had to pick one of these as like the most common pitfall. Which one would be the thing that you see people make the biggest the most often mistake made?
Yeah, I think it's probably a mixture of hedging at the worst time and not having things in place when things are ready to go. Hedging at the worst time can mean a lot of things, both panic buying at the lows, or it can even be what we just touched on there, really, which was like systematic hedging based on the calendar rather than actually your underlying requirement. But definitely not being reactive and emotional about the hedging decisions, just having a plan. I think that is probably the most common pitfall.
Okay, thank you.
Yeah, so I mean, ultimately, we are in this weird environment where we've just come off the lows. Margins are a lot thinner. Some of this might be out of context a little bit, but ultimately, I think a lot of it still holds true in terms of, yeah, revenue is going to be lower, cost efficiency is going to get more and more important. Things are becoming more expensive, energy is becoming more expensive. There's a huge, obviously, other macro lever that's going on in the background, which is going to drive up costs, and therefore the volatility of revenue from just outright Bitcoin sales is getting more and more important with the thinner margins. So the benefit of that is that we now have much more liquidity in the options market and a lot of sophistication and risk management tools that can be used. And a lot of these are very, very standard tools going back to cookie cuttering from traditional finance, and the vast majority of people that we interact with in Treasury seats now have some idea of what they want to do, and then it just enables us to sort of layer something over the top. So there's a lot of different things that we can come in and help with based on that. But yeah, I think the use of these treasury tools is just becoming more and more important basically as the industry matures.
Okay, so that's a great summary. Do you have any final advice here for treasurers watching today?
Yeah, so I mean, when I started throwing this together, I think we started at the key takeaways to be like, what would I really want to try and impart as we are ending this discussion? I think first of all, by and large, know the floor. I know that for some people that will be very, very obvious. For others, it doesn't seem to be. Knowing the all-in cost, not just, okay, what is the gross here? What else do we actually have going out the door? And all of that, if it's put back to the cost of one Bitcoin, it then becomes much easier to build everything around it. That then allows you to really hedge the gap between your assets or potential incoming revenue and liabilities, and ultimately use the tools because they're there, and the industry has grown so large for a reason, and that is that they are having a positive impact on treasuries, on shareholders, on ability to ride cycles out, because I guess that's important. And actually just get it ahead of the curve, basically. So without turning it into a big sales pitch, which obviously it's not what I really wanted to do, rather than just come in and try to hopefully educate people on the tools that are available, but getting things in place beforehand. So then when the decision is made or when they're most needed, things are ready to go. I think that's really one of the main takeaways to dig in at this point.
Awesome. Well, I'm going to open it up for questions. If anybody has a question for Jake, please drop it in the chat here. I do have a couple of questions for you, just to reiterate a few things and clarify. Yep. So first one is, for a miner just getting started, what instrument would you recommend first? Like a collar, buying puts? What do you think?
I think in terms of just outright getting comfortable with options as a tool, I think puts are always going to be one of the most useful things in the toolbox. The reason being is that it gives you a lot of headspace and freedom to then think about other things. Like a treasury strategy is not going to be just decided in a day or often a week or a month, but having puts in place just gives you the ability to then work out what is entirely optimal while still having a floor on the sort of exposure, basically. So I think in a very, very easy form, that's a good place to start. Then the natural progression seems to be, okay, well, actually now instead of paying out these puts, let's now look at how we can make them zero cost. And then before people look to lean on call selling in a collar kind of strategy. But those two tools together, I think, is where most people start.
Okay, next question I've got here for you is, how do you help miners decide how much of their production to leave unhedged?
Good question. And that's not something that we would push in terms of our opinion. We can give an opinion on where we think the market is going. What normally happens is that a miner will come to us, they will already have an agreed strategy or mandate in terms of, okay, we actually are deciding that this vehicle is a high beta to the market, and therefore we want a lot of upside exposure, but we like volatility. Others might say we want upside exposure, but actually we're willing to give up a little bit to hedge. So it all comes down to mandate from the firm initially. We do get involved in thinking about the probability of the markets moving one way or the other. That said, it obviously, it comes down to, like, we can provide a lot of color about flows, potential, like, forward-looking, I guess, forecasts, but it comes down solely to what the initial treasury is wanting to do and really what the mandate is.
Okay, we touched on this a little bit before, but how should a hedging strategy change in a bull versus a bear market?
That's a really good question. And I think, again, maybe going back to another thing that we do see people doing is people try and tend to do this in the opposite, in terms of, okay, when the market's going up, people just tend to sit on their hands, not really actively manage the strategy, and therefore don't actually capitalize on the fact that the market is very, very strong. The market is cyclical. Every single market is cyclical, and the inherent volatility in Bitcoin means that actually actively managing in a bull market can add like almost more, if not the same, to the bottom line than managing in a bear market. And how that might look like is, okay, if the market is going up and you are looking to sell maybe at higher prices, maybe you're just leaning on selling covered calls, which means that, okay, if the market is going higher, you're receiving a premium from that, so you're generating yield in a bull market, and also you're able to then sell some treasury holdings at higher prices if the market continues to rally, which can then be bought back by selling puts or something like that. Whereas in a bear market, it becomes more active hedging, aggressively trying to make sure costs can be covered. Some people will, if they've really managed the treasury well in the bull market and they've managed to monetize a lot of it, what we see a lot then being able to do is they'll be sat on a lot of cash and then they'll be accumulating on the downside. So it depends how active people want to be, but I think, yeah, the market does dictate largely how things should be approached. And that's not just price volatility, it's the volatility of options pricing, it's the skew in the options market, which I guess a little bit more technical, but that comes down to the color that we can provide in terms of maybe the right way to hedge or the right way to be thinking about it as the times come and the market shifts around.
Okay. And the last question I've got for you here today is, what is setting up an ISDA actually involved for a company?
So it sounds big and scary, but so the ISDA agreement is basically a framework which has been pulled over and very well documented in traditional finance. That means that there's a huge template. What an ISDA basically dictates are margin terms. By and large, what we see treasuries doing is fully funding option strategies. And by that, I mean, when they come and they sell a call, they will do it with collateral to the tune of 100%. So if they want to sell a call on 10 Bitcoin, they will post 10 Bitcoin as margin with us or with a third-party custodian. Under those terms, the ISDA agreement would basically dictate when we settle the trade and almost that in entirety. So therefore, there'll be no margin terms. Where the ISDA comes into play is when people want to get a little bit cuter with strategy and say, okay, we want to sell a cover call on 10 Bitcoin, but actually we only want to put 2 Bitcoin there as collateral. And what that ISDA will dictate is like when people can be called for additional margin, what the initial margin requirements are, where the margin would sit, i.e. with Wintermute as a desk or whether it's with a third-party custodian. And then there'll be tri-party agreements involved. There'll be things like minimum transfer amounts, i.e. when we can call for more margin, alongside different clauses about, let's say, different chop outs in the trade, that sort of thing. So by and large, the ISDA agreements are fairly simple. They get a little bit more nuanced when we're talking margin terms and what collateral arrangement we're using. But yeah, by and large, I'd say 80% of the trades that we're doing are on a fully funded basis, and therefore it allows people to basically set and forget kind of different hedges and then manage them as they come to expiry rather than through the life cycle of the trade, which would then be governed by an ISDA.
Well, thank you, Jake, for all of your time today. That was really eye-opening and extremely interesting. You know, I mean, I guess personally, as a smaller miner, I don't have an industrial facility, but I never would have thought that in a down market, you could hedge against it, you know, insurance style. And I've always thought about it as just like, all right, well, hold up cash reserves and just get ready to pay out when things get scary. So, really gets my brain thinking, and I hope other people watching this have taken the value that at least I have out of this. And thank you for your time. So if somebody wanted to take a look at, you know, possibly working with you guys at Wintermute and getting some hedging going for their own mining operation, how can they get a hold of you guys?
Yeah, so you can contact us a couple of ways. The easiest one is to send an email to otc@wintermute.com. That will come directly through to my desk. And then we can set up an initial call just to work out what the requirements are, how we can fit in, and then we can look at a sort of more bespoke treasury strategy. If you have direct questions, you're welcome to message me on Twitter or X, as we now have to call it. My handle there, which isn't in the slide, but it's JO_Wintermute. And we can chat there. Feel free to send me a DM. We can move it to Telegram. And yeah, so hopefully see some of you soon. And yeah, let me know if you've got any questions.
Well, thank you again for being very generous with your time today and giving this excellent presentation. We will see you next time on MasterMINED.